Picture this, you're in contract with your dream home, but then the deal starts to fall apart. But you did everything right. You even have an official pre-approval letter and all that stuff. But then these 3 silent mortgage killers snuck in there and blew it all up. So what I'm gonna show you is how to spot them, and more importantly, how to avoid them before they take your dream home. And spoiler, one of them's fast food mortgage lending. It's quick and it's easy, but it'll wreck you when it matters most. So let's get right into it.
Silent killer number 1 is budget assumptions. People guess what they think they can afford based on rent, Zillow, or what their friend maybe even paid for. And buying a home without real numbers is almost like training for a marathon in sandals or even Crocs. Training for a marathon is already hard enough, right? But I'd rather have you guys train with the right shoes. So sure, you could technically get it done by training and pushing through the hard stuff in sandals, but it's gonna be torture on your feet and even your joints. So let me explain why it's silently dangerous to work with budget assumptions when house shopping. Let's say you're looking for a house and you're over here, you're smiley, you got some hair, and let's say you're looking at a house and you think you can afford, $3,000 a month. And again, I'm just using this as an example. So your situation could be totally different, right? $3,000 a month, and then you're going on Zillow as an example, and then you can see maybe it's like a, $600,000 house, and you're like, wow, this is amazing, right? But then what happens is, and I know this for a fact because I run into this quite a bit when clients come and they're like, okay, I ran some scenarios and I think I can afford 600,000, and the real numbers end up being shockingly less, okay? So here's what the problem comes into play is usually Zillow will use estimates that are completely underestimated, especially property taxes. So anyone watching this, especially in California, do not use the property tax estimations for Zillow or even Redfin or other tools out there, because like I said, they're going to severely underestimate the taxes and more than likely the insurance as well, even mortgage insurance. So that number that they give you based on 600K is almost like I'm gonna be going left, or you're thinking that you're going left, but in reality, you should be going right. So you end up wasting this whole time by going this way, looking for 600Ks when even though you should have been looking at 400,000 to maybe 500K. In your area, that might be a massive difference from what you actually could get. So this could be a difference from, hey, I'm in a B-class neighborhood to an A-class neighborhood or something like that. So this is almost what I call the heartbreaker mistake, which is, again, you're like set on this. You love, you love this house right here. And then I'm over here, gotta tell you after you chat with me over here, and then I'm gonna try to draw a heartbreak. I don't know how to draw this, but yeah, that's a heartbreak. But I break your heart and then I seem like the bad guy because I'm telling you the truth, right? So that's the brutal truth, and that's why it's actually extremely dangerous. So what is the solution for this silent killer of budget assumptions? It's kind of a 3-step process or 3-step playbook. And let's talk about the first pillar. And I call this the homeownership free trial, which is something I developed. I don't know if there's anybody else who's talked about it online, but it's something that I've, kind of said that is part of my process, especially whenever a first-time home buyer comes in and they don't know what budget they want to work with. So I always recommend the homeownership free trial. So let's go over that pillar first. So there's 3 pillars. I'm going to go in that pillar specifically. And within that, let's double click into it. And there's going to be 7 steps, but I promise it's going to be very simple once I jot it down. And then again, you can even screenshot it and, download the information if you need to. First, what you want to do is you want to find your before tax income. Okay. So for example, before tax income, let's say that's $10,000 a month. That's going to be the highest number on your paychecks. You don't want to take your net pay because that's not going to be helpful for this example, but you want to do before taxes, which is technically called your gross pay. So again, it's your highest number. So let's do your before tax income. That's going to be denoted, sorry for that there, but before tax income. Okay. You're going to take your before tax income. Number 2 is you're going to take that, let's say it's $10,000 as an example. And again, I'm just using this for simple math. So it's easy for you, easy for me to calculate. We're going to take $10,000 a month. So take this and multiply it by 33%, which ends up being, in this example, $3,300 a month. Now for the math nerds out there, I get it's $3,333.33, rounded up to maybe 34 cents. But just to keep this example simple, this is going to be basically, I'm going to label this what's called an HPMT, which is your hypothetical payment. Okay. So this is going to be a very important number that we're going to use in the future. So this is a hypothetical payment that we're going to work with. And this is, again, super helpful for first-time home buyers that that I meet and they're like, I don't even know where my comfortable budget should be. If it should be what my rent is, slightly above it, etc. I always start with 33% of your income first as a starting point. This doesn't mean you're signing your life away. It's just a starting point. So number 3 is then you're going to subtract this HPMT. I know it's math, but promise it's easy once you know the formulas. Rent, HPMT minus your rent. So let's say your rent is like 2,000. I know that's super small to see, but or 2,300. Let's do 2,300 just to keep it simple. So what's the difference between 3,300 and 2,300 is simply $1,000, right? In this example. So that's going to be your difference, and we're going to use that in the future. Number 4 is you want to do a high yield savings account. So what you want to do is for number 4 is open a high yield savings account. Okay. The reason for that is these high yield savings account are going to be about 4% return as of recording this compared to the standard savings account, which is about 0.4%. So again, that's 10 times more output for the same input. So let that sink in. Okay. It's almost like if you take your salary, multiply that by 10 because you're going to be working the same hours, and that's like what you get, the output, right? So that's why I always recommend a high yield savings account. And here's a little bonus tip. I call this account, and hopefully you can name it. Hopefully I spelled that right, but I call it the freedom account. I know it's corny, but we're all humans, and just keeping things fun is how you stick to it, right? So I call it the freedom account. And here's a few other tools that I use, which is Amex and Wealthfront, or those are the accounts that I would recommend for home buyers. Not affiliated with them at all. Don't receive any referrals. That'd be great though, if Amex could. But basically I name it freedom. And the reason why I use Amex and Wealthfront is you can, or even SoFi, you can set up all those accounts online, and you don't have to go into the branch and set that all up and, waste an hour of your time. You can literally set this up after watching this video. Number 5 is now you want to take this difference from step 3. So you want to take number 3 and transfer it to freedom. Okay. So you want to take number 3, which is your $1,000 a month, and transfer it to your freedom account. And then here's a little pro tip. I recommend having this have a little friction between the transfer of $1,000 from your main checking account to your freedom account. And what do I mean by friction? It's not like the friction, like, rubbing against this paper, but it's just adding a little more effort to check how much money you have in your freedom account. So here's the bonus tip is if you have like your main checking account that pays all the bills, like for your rent, living, credit cards, etc., in one of the major banks or whatever, I always recommend an institution that's not the same one. Meaning, for example, let's say Chase, right? If you have Chase, you have all your accounts show up on your mobile app. That is, I would recommend creating Amex or Wealthfront for your high yield savings freedom account. The reason why is because you have to log into another app, do your Face ID, or even disable your Face ID. So you have to plug in the password and try to remember that, right? And that causes a little more friction. So that way you're not always checking on this account thinking it's like, oh yeah, this is free money that I can use today. No, we want to set this up for the future, right? So again, that's step 5. So number 6 is check your checking account. There's so many checks, right? But what you want to do is basically check if you have enough money in your main account that pays all the bills, like your rent, car loans, credit cards, installment loans, whatever, right? Student loans. Make sure you had enough money. If you didn't, then that's where step 7 comes into play. Number 7 is adjust, which is adjust number 2, which is your hypothetical payment, which you're going to use right over here. Okay. If you had enough money in your account, like you paid all the bills, etc., and again, even with after transferring the money to your freedom account, then what I would recommend is next month is that you would increase your hypothetical payment. Let's start with $500 in this example. Now, again, that's an adjustment that I believe your mortgage advisor should make. I would recommend maybe $500 for this particular client because maybe based on their scenario, their income is on the higher end, their credit's on the higher end, etc. I would recommend maybe $500. So I would increase this to $3,800, redo the exercise, run through 3, 4, 5, and 6, right? This time it would be, guess what? $1,500 a month instead of $1,000, right? Make sure you had enough money and then you're good. And the goal is continue to increase it until you hit the uncomfortable threshold. Here's the cool part is you don't want to stop there, is then you want to take that number, the maximum comfortable payment where it gets uncomfortable, decrease it from there. So you basically expand and then you decrease. It's almost like working out your muscles, right? You're going to max out and then you're going to decrease the weights, and that's like your working set, right? So that's how you do it if you had enough money. Now, the $1 million question is like, Nathan, what if I didn't have enough money? What if I couldn't have paid all my bills, etc.? Now, what you want to do is obviously pay the bills, don't increase more debt, transfer the money from your freedom account back to your checking account, then pay your bills, right? Because the cool thing is this is your money, so transfer it back and then pay the bills, right? Don't get into more debt. So that's the good thing. And then what you want to do is actually decrease your hypothetical payment. So in this example, I maybe subtract $500, so to $2,800 a month, redo the exercise and check to make sure you had enough money on step 6. If you did, then I would slightly increase it, maybe like $100 to $200, redo the exercise. And then you're going to do that exercise for a few months and then really figure out that's good to go or it's not. So again, what I love about the homeownership free trial, this little process that I've kind of developed here, is worst case, you actually are uncomfortable and you're like, Nathan, I didn't have enough money. We created a 4 savings account. That's a high yield savings account and you're making 4% as of recording this, right? Best case, you actually find your actual hypothetical payment and you fine tune it to perfection. You pass this on to your mortgage advisor and they're like, wow, this is amazing. So again, that's your best case, worst case. That's why I love the homeownership free trial. Now that we talked about the homeownership free trial, let me kind of walk you through what it would look like if you integrate this well with your mortgage advisor. So basically what you want to do, and this is my recommendation, is you want to take your homeownership free trial process and what you came out at the final step, 7 right over here, and then you're going to condense this homeownership free trial into a number of some sort. And then what you want to do is actually give that information to your mortgage advisor, and what they should be doing, again, this is should be, again, if they're not doing this, then I would question the who, not really the what, but it's a who problem, is they should pipe this into some sort of purchase analysis or some sort of way to compare multiple mortgage options and recommendations using and starting with your homeownership free trial number. And maybe it's going to be conventional versus FHA, this down payment versus that down payment, this interest rate versus that interest rate, this down payment assistance versus that down payment assistance. Basically pipe that information in to figure out what house price range you should be looking at. And by doing so, you're going to avoid the heartbreak scenario, which is right over here, because you're actually going to have ultra clear clarity on what the house price should be versus what it should not be, right? So basically, like I said, you're going to pipe this information in from your mortgage advisor and the analysis that they provide, and essentially you get rid of the heartbreak scenario and you just avoid all of this guessing just in general. And that way you actually have a system and a process. So let me give you an example of one of our home buyers that we met, and they thought they were fine, based on a $700,000 home, based on their income. After running the numbers, they realized that they were way more comfortable at a $625,000 house and 3% down using the homeownership free trial, which is again super great that I got to see them watch the videos. I think this was like 6 months, maybe 5 months ago. They watched my video on how to buy your house in the next 12 months, and they used the homeownership free trial and actually gave them a lot of clarity. And when I met them, they actually had really a head start compared to everybody else. So please use this to avoid budget assumptions. So let's move on to silent killer number 2, which catches even smart home buyers off guard all the time. So silent killer number 2 is the credit trap. I'm gonna flip a new page so we have new stuff to work on. But like I said, this even trips out even smart home buyers too, because if we're focusing on the wrong thing, you're not gonna get the right thing. All right, so this is kind of multifaceted, the credit trap. The first thing we wanna talk about is focusing too much on the score and not enough on strategy. So what a lot of people think about is, hey, when I start the home buying process, I want perfect credit. I want that 740, 760, 800, so I get the best rates. Now, what I want you guys to be cautious about, if you're watching this, is really figuring out what is the constraint for your whole home buying system, I should say, right? So I'll give you an example. So this is called the lending trifecta. Again, something that I, thought through, and it's based on income, credit, and then savings. Okay, so that's the lending trifecta. It basically uses the theory of constraints, just fancy words for what's the actual constraint, because there's only one technical constraint, and you want to focus all your attention on there. So let's just give an easy example. Let's say you have a credit score of 740. You have income of, let's say, 200,000. Well, doing really well with 200,000, right? Depending on where you're buying, right? But your savings, let's say you got $10 in your savings account, right? So what some people may do, again, even smart home buyers, is what they'll try to do is, okay, I'm going to focus all my attention going from a 740 to a 760 plus, right? And guess what? It takes 3 years to do that. So what's going to happen is that house price that you were looking at 500,000 is probably going to be worth 600,000 3 years from now or 5 years from now. But basically, the house prices got more expensive because of inflation and just supply demand. The issue here is some home buyers don't know this, but usually if your credit score is above 720 or even 740, there materially isn't a massive difference in your interest rate, especially for first-time home buyers right now. There's a lot of first-time home buyer pricing credits, I should say, for conventional loans. And if you're getting an FHA loan, that going from 700 to 720, 740, 760 makes no difference at all. So it actually depends on what vehicle loan you're actually getting. So this is a terrible example of focusing on the wrong thing, or I guess it's a great example of focusing on the wrong thing, double negative. What you actually want to focus 100% of your attention on is, why are my savings at $10 a month or $10 total? Focus all of that to get that higher. Then we can focus on this later, and maybe a new constraint will pop up. So what I'm trying to get is, some people think having a higher credit equals exactly the best rates. Yes, materially, if you do have a higher credit score, it could help your interest rates, but you have to find the constraint first. And also, what type of loan program are you looking for? Because if the loan program where it doesn't really get affected by your interest rates, then I don't want you guys to waste like 3 years of your life and then regret not making a home purchase, and then just knowing like it's a lot higher in purchase price now. The other thing with credit, I should say, is sometimes what happens is, just removing this completely, is some home buyers might actually pay off the wrong debt. So what do I mean by that? There's a difference between installment versus revolving. So installment is going to be like your car loans, student loans. It basically has like a fixed payment and a fixed amount. Your revolving, you can change the balance every single month. Think of this as almost like a credit card. What I see sometimes is some home buyers will actually pay off their installment because they're like, hey, this is going to help my cash flow. Like, let's say it's a car loan, right? It's like $500 a month. And then they see their revolving and it's like, hey, this is only like $100 a month, but their balance is what, like, $5,000, right? A month. And then this is again, like $5,000 as well. They're like, whoa, Nathan, I got $5,000. I might as well pay this off because it's gonna save me $500. And this one, I have a $5,000 balance, but I'm only gonna knock off $100 a month. So I'm gonna pay this off, so I have $500 extra of cash flow. But what they don't understand is, maybe they got this car in like 2020 or 2021 and the interest rate is 0%. But guess what? Credit cards rates change every single month. And this is probably at 20%. So this is a negative 20% return, and this is a 0%. So I'd rather have a home buyer focus all their attention on revolving. But again, you don't know that until you actually get into the weeds of it. You take a peek under the hood, right? So that's also a mistake that I see quite a bit. And again, this is like a little silent killer, because you think I'm doing the right thing by paying off debt, which you are. You're paying off debt, which is great. It's more of focusing, doing the right thing first, and then doing the next best thing after. Okay. And the other thing too, and the other like little silent killer with installment loans, if you pay this off or even close it out, whether that's installment or revolving or like credit cards, is a lot of people understand this is, your credit is based on how long your credit history has been open. So again, maybe when you got your credit when you're 18 or 21 or whatever, your credit score is really low. And as you grow older, you have more history. Therefore, your score just naturally increases, assuming you paid your bills on time. What happens is, some of the student loans out there, you might have got 10 years ago. So closing that installment loan out, and let's say you have like 10 years ago, you had student loans and then nothing new until your credit card that you opened 2 years ago. If you close out this installment loan, your credit history or length is going to go to like 2 years instead of 10 years, right? So this is where paying off an installment could be detrimental and a silent killer to your home buying process. The other thing is revolving. If you have a credit card that's been open for like, again, 10 years, and then you close it out because like, I never use this, Nathan. Why would I have this open? Because it's tempting. By closing this 10-year one out, and the next earliest one that you have is 1 year old, now the credit bureaus just think that you have a 1 year credit history, right? Which isn't as beneficial as 10 years. So my recommendation is always, if you have a 10-year account or a really old account that has good history, just put it somewhere where you can't see it, right? It's kind of like out of mind, out of sight, instead of like chopping it off and throwing it in the trash and canceling and closing it out, right? And this is one of those things where out with the old and in with the new does not apply. So keep the old, keep the new, just pay the balances down. And the other side tangent that I want to talk about is, buyers always like to check with Credit Karma, Mint, all these free credit apps, maybe with the banking apps and stuff like that. So just know that those are different, let's call it models, and they're not exactly what the lender will look at. Additionally, sometimes it's like 1 out of 3 types, or 1 out of 3 credit bureaus, so Equifax, Experian, and TransUnion. The lenders will actually use the middle score. So if there's 3 scores, let's just say it's 700, 710, and 720, the lender will use that 710 credit score. So if for some reason you're like trying to optimize this 720 to 800, but we don't get the middle one up, effectively you're just not getting the score that the lenders will use. All right, so here's another bonus tip regarding credit utilization. So I'll draw this example here. And this is something, again, smart home buyers will not even know. And because you're watching this video, you're gonna learn. All right, so let's say this balance start date for your credit card is on the 1st, okay? Then, actually, Reality, it's gonna be probably the 5th, okay? And then this is gonna end on the 4th, okay? So what happens is, let's say this is like this month and this is next month, right? So what happens with credit utilization is a lot of people will think, okay, so here and then here, it generates a bill of, let's say $1,000 is my statement balance. And they're like, Nathan, I pay this off every single month. And when you got a credit report, and I can see that here, your soft credit check or even a full credit report, and they're like, wait, I paid this off. Why is there still $1,000? What the credit card companies don't tell you or don't advertise, and I don't know why, but like they should, but because again, you're watching this, you're gonna learn this. So what you wanna think about is on the 4th, think of like the credit companies almost taking a snapshot or like a picture for that $1,000 balance, and then it sends it to Equifax, TransUnion, and Experian, and then the $1,000 gets posted, right? What you actually wanna do is pay it a little sooner if you can, again, the budget, if you can, a few days before. Maybe it's the 2nd. Then you pay the $1,000 on the 2nd here. Then what they're actually gonna report on the 4th is now they're gonna report $0. So that's how you really maximize your credit score, especially if you're like starting out the home buying process, etc. Is you wanna look at when your statement balance end date is, not the due date, but the end date. So maybe it's the 4th, you pay it a few days before. So again, you're gonna see that on your credit card statement. They'll clearly lay it out, like end date, statement end date, balance end date, whatever it is, date, end date, something, pay it a few days before, and then they'll actually report the paid off balance. Those are some tips and tricks that will definitely help you, even if you're not buying a house. So the way that I like to look at this is the analogy I like to use. It's like cleaning your room before your mom comes in and checks in on it, not after. So again, you're gonna clean your room on the 2nd. That way, your mom comes and checks the room, it's clean, $0, right? Because she comes and checks on the 4th, okay? What you don't wanna do, like I said, is on the 4th, mom sees your dirty room and they're like, yo, it's dirty. What's this $1,000? We're gonna penalize you for that, right? So like I said, clean the room before, that way your credit is sparkly clean. So all in all, this credit trap that I'm talking about, again, focusing on the main constraint. Is it the constraint? Focusing on installment versus revolving, paying off the right debt, making sure you clean your room before your mom comes in, right? All in all, if you chunk up, what I'm trying to say is your credit score is like a parachute. You don't want to find that it has all these holes after you've jumped. You want to work with somebody who actually can help double check and inspect everything. Again, like peek under the hood and just make sure the parachute's all perfectly fine. What you don't want to do is kind of self-diagnose the parachute after you've jumped, right? So that's what I'm talking about. And again, if you got your credit locked in with this silent killer number 2 and you're like, Nathan, I got my credit locked in, that's totally fine. What I want you to also think about is basically silent killer number 3 is like, what if your lender disappears when it matters the most? So let's go into that. Silent killer number 3 is fast food lending. So buyers that work with fast food lending, let's just say, they give you a piece of paper and they disappear. There's no guidance, no updates, and really there's no planning. So what I want to do is talk about my personal experience when I bought my first house. And I remember getting a call from a recommended lender, and the whole call was like 10 minutes. And they're like, okay, cool, this sounds great. They asked about my budget, which I had no idea. No one developed the Homeownership free trial yet. And that's where, I had that conversation. Like I said, it was like 10 minutes maximum. And I'm being pretty generous on that. And I do remember after the fact when I uploaded the documentation, uploaded the questionnaire, and then they came back with me with a giant pre-approval amount. And I'm like, oh, okay, that's cool, I guess, but I don't think I'm really looking for that because I have a hunch that the payment's gonna be astronomical. And again, this is like 10 plus years ago, so it's funny looking at the astronomical payment now, it's like probably not that much, but at the time, it would look very painful. And the downside of the fast food lending, I should say, is I didn't know what to do right after that. I was like, okay, so cool, do I do this and look at houses at this price, or like what's going on here? That's why having like really detailed analysis would be super helpful. But basically, it's just like the drive-through of lending, right? Like you just show up to the drive-through window and they're like, hey, they ask you questions. Hey, do you have our mobile app? I'm like, no, I don't want to download your mobile app. I don't want more subscriptions and data tracking or whatever. Just give me my food. But anyways, you see on the window, it's like this 2 for $6 deal or something like that. And you're like passing by it and you're like, that sounds great. And then you get the bill, it's like $15 or it's just something that you completely didn't expect. All right, $15, we got the package. Or even worse, you're going through the drive-through and you don't even know what to do. Kind of like what I did was like, I don't know where to go. So do I order now and then I drive up to the window? Where do I pay? How much do I pay? Where do I go eat? Where should I go look? If I don't want to eat right now or buy right now. It was just the wild, wild west. And I was just, flying through the sky, almost like skydiving, again, with the parachute analogy with the holes in it, and it's just flying all over the place. Big Mac combo meal. And here's the worst thing too, right? Like with the fast food lending is, worst of all, you may think it's good for you because it's like, oh, it's the 2 for $6 deal, right? And the downside is long-term wise, it's not good for your health. And also you feel awful afterwards. So just think of that almost as like home buying, where you think you're getting a good, healthy loan, but you might've been leaving money on the table if they would have had more time with you and they invested more education. So they could actually really understand what destination you're trying to get to and then reverse engineer from there. Because fundamentally, you can't have a clear destination if they talk to you for 30 seconds. It's like, it's impossible because you have so many complexities with your life, right? So with that being said, let me also explain why it's also dangerous working with, let's call it fast food lender. And I also want you guys to understand, fast food lending is supposed to be better priced. I can promise you that, being on the other side from retail, mortgage broker, and everything in between. There are mortgage brokers out there that run their margins really thin and have very competitive pricing compared to, let's call it fast food of lending. So there are people out there. Like I said, I'm a big proponent. It's a who problem, not a what problem. So find the right who, and I really believe that they can solve your problems. So let's talk about why it's dangerous is sellers don't trust pre-approvals from those lenders. And I say pre-approvals in quotes because really they're pre-qualifications, right? And if you think about it, there's really two ways that a deal can fall apart. It's inspection and financing. So if the inspection's fine, and they're like the sellers, right? The listing agent, it's like, I know my property's fine. So I know the inspection's fine. So all the risk is on who they actually accept the offer from, who has the financing, right? So if you have questionable financing, that's going to cause a lot of issues when you actually submit your offer and you have another competing offer with very strong financing, right? So let me actually show you an example, what I call the pre-qualification trap. So if you look at this, to the untrained eye, everything looks perfectly normal. And that's the issue. As a home buyer, if you can't even tell the difference here, that's the trap. What I actually want you to understand is this is a pre-qualification. The issue here, you can clearly see that it says stated income and stated assets. So literally, if I go into this notorious lender and we plug in $10 million of income and $10 million of assets, you legitimately would get a pre-qualification letter of like $20 million, like straight up. They would just generate it and you would get this and you'd be like, oh, this is legit. This is awesome, which is great for, you know, your ego. But in reality, the sellers and the listing agent, the one representing the sellers, if they have any experience in the industry and they see pre-qualification, they're like, what are you doing? Like, this isn't right. And to even further reinforce it, if your buyer agent submits an offer, especially in California, other states, you'll have something very similar to this, but it breaks it out into 3 different types of what the lender actually did to review your file, right? And there's pre-qualification, pre-approval, and fully underwritten pre-approval, which you can see right over here. So what you want to understand is pre-qualification is like the lowest tier. It's all stated income. That means that you have to, as the home buyer, understand all the lending guidelines, know that you're calculating your income correctly. Sure, if you're salaried, that it should be pretty easy, but if you have any sort of bonus, varying income, or you have a rental property or self-employed income, you're definitely not going to get the income calculation correctly. Even some mortgage people get it incorrectly too. So pre-qualification is the lowest tier. Pre-approval is going to be kind of like your normal standard. And what you want to understand, the difference there is you have your questionnaire or application and you have documentation to verify and cross-reference it. So I always like to give the analogy, it's like you're baking a meal or a cake. You're going to need the ingredients, right? And you're also going to need the recipe to make the cake. If you're missing one of them, there's really no point in making it, right? Because you can't do it. The other thing that you want to look at is the fully underwritten pre-approval, right? What that means is you actually sent it to the lending underwriter, and the underwriter is the one who actually like gives the stamp of approval. It's not me. It's not anybody that you actually talk to. It's completely third party and separated, obviously for compliance, safety for the bank, and safety for you, right? So they're the ones who actually review your file before you find a house. I love this. And what you can actually see right over here is we did this for our clients recently. This was about 2 weeks ago when they closed. So it was about 3-4 weeks when they got their offer accepted as of recording this. And because they were fully underwritten pre-approval, we were able to ask for $8,000 in seller credits to cover their closing costs by simply offering a faster closing and higher certainty that the financing will go through because we already had a lender look at the file. So what I actually want to do is give you the winning formula that I was actually thinking through when I was making this video. I was like, wow, this is going to be amazing. And hopefully this makes sense for you. So I'm going to give you the winning formula and I want you guys to write this down. This is how to show the highest value to the sellers. So I'm going to write winning formula offer. So here's your winning offer formula. So if you reverse engineer all the factors to maximize this number, that will be the winning offer. okay? So what you're gonna do, you wanna take your offer price minus clean. I'm gonna go over what that means in a second. And I don't mean cleaning your room. I know I was using the mom checking your room analogy, but that's not what I mean. Okay, so clean divided by speed. Whoa, what does that mean too? I'm gonna go over that in a few seconds, okay? So literally, this is the winning offer formula. There's one thing to write down in this video, this would be it. So this is the winning offer formula. So you're gonna take your offer price, so let's call it like 500,000 as an easy example, minus clean. So what this means is, how clean is your offer? Are you requesting $10,000 in seller credits or 8,000 in seller credits like I mentioned above? Like, am I also requesting, hey, I want you also to clean the house, like literally clean the house before I buy it. I also want you to pay for my mortgage for 2 months because, you know, it's gonna take me 2 months to move in. And I also want you to clean my car. And you know what? That dog you had, we're gonna keep it too, right? Obviously you can't do that, but how clean is the offer? If you have nothing, meaning you just offer and no other T's and C's, you're gonna be standing out as the winning offer compared to everybody else, okay? So that's how you would interpret clean. Then what you wanna do is take your speed, oh, this is spelled wrong, speed, not speed, speed. So speed to close. So what that means is if you're getting a loan, you can close as fast as like 60 days, okay? So speed, let's say it's 0 days to close to 60 days. The fastest you can close a loan compliance-wise, a regular loan is about 10 days. The national average is around 42 days as of recording this. If you're in California, you know, the normal is gonna be about, 30 days, okay? So if you can offer very fast closing, you're gonna divide by a small number. So if this was, technically can't be 0 because it would be 1, but if you divide this by 1, it wouldn't change any of these factors. It wouldn't lower the number, right? If I put 10 days, it would lower the number a little bit, but if I put 60 days, it's gonna lower the number a lot, right? Now, what I don't want you to do is take this winning offer formula and be like, okay, this is exactly what the seller's dollar amount's gonna get, but you wanna think about, how do I increase this as much as possible? But maybe you don't wanna increase it because you wanna, save some money, but you also want to decrease this as much as possible, and then you wanna decrease this as much as possible too. So let's say you wanna have a low offer, then how do I lower my cleanliness or make the offer super clean? And how do I offer very fast speed to close to help offset the lower offer, okay? So this is how I would use this winning offer to win and outcompete the other home buyers. So with this all being said, to avoid silent killer number 3 and what the solution is of the fast food lending, which is basically not understanding what you actually really need, and they also should be helping your offer get accepted. The solution to that is work with somebody that has clear process that can actually walk you through how can you get your offer accepted, because if you're trying to get your offer accepted and you don't get it accepted, there's no point in getting a mortgage, right? Because you need a house to get a mortgage, right? So you want to make sure that person can help you get your offer accepted. The second thing is, do they have like a clear process to understand your goals and reverse engineer from there, right? And as human beings, I think we're really good at like kind of sniffing out if they're able to do that, right? So when you actually chat with somebody, whether that's fast food lending, mid-tier lending, top-end lending, whatever you want to do, right? Is you want to kind of get a sense, is this the person who's going to get me closest to my goals and at a competitive price, rates, etc.? Because those are obviously very important. Is you want to kind of include that in your total decision matrix, if that makes sense. So like I said, that's going to be how you combat the silent killer number 3. Is work with somebody who can get your offer accepted, and then also, can that person get you closer to your goals? So putting it all together, these are the 3 silent killers. Again, no one talks about them because they're silent, but they are real, and I see them every day. If you want help walking through what options make sense for you, there's a schedule link down below. I would look forward to getting to know more about you. And like always, I do my best to put everything into making the best mortgage videos. So if you like videos like this, make sure to like, comment, and subscribe. And by the way, if you own any stocks and you're wondering, how do I sell this and minimize my capital gains because I'm trying to buy a house, make sure to click this video, and I'll see you right there, and I'll catch you on the next one.